How did this real money live traded portfolio fare in the month of August 2023 and the years prior, as I continue to chronicle its life journey? We're going to get right into it and start off with August's percent returns. My live traded US stocks portfolio outperformed by 1.1% by being down 0.49% for the month, compared to the S&P 500 total return index being down 1.59%. A month is very short term. We shouldn't make big changes based on 1 month's performance, regardless of how wide the comparison is in any given month, because we don't manage portfolios of stocks for a month, 10 months, or 10 years. It should be more like 20 plus years. Very different to how traders will last trading crypto and FX. Over the last 12 months to August 31, 2023, my rules-based US portfolio was up 25.04% compared to the S&P 500 total return index, which was up 15.94%. A good year for the S&P 500, but even better by this rules-based real money portfolio that I've managed since 2016 as an open book for my customers to learn from. That's 9.1% outperformance by my portfolio for the year. Now let's compare these two returns to a balanced fund. I will use the Vanguard Balanced Fund, which is where John Bogle, the founder of Vanguard, said for decades he had invested around half of his capital. In August, the Vanguard Balanced Fund was down 1.46%. Over the last year, the Vanguard Balanced Fund returned 7.56%. I will use VBIAX as a second benchmark for performance because it represents a 60% stocks, 40% bonds investing formula, which is how a massive amount of long-term money is invested for 401ks and IRAs in the United States and around the world. Let's now look at some metrics for this real money portfolio over the last year. This analysis exemplifies the type of portfolio measurement and benchmarking that all investors should do, regardless of whether they are active or passive. Yes, passive too. Everybody should measure how well or poorly their money is growing. Few do. The value of this portfolio on August 31 is $163,251, having started out with $70,000 back at the beginning of 2016. 1 year ago, the portfolio value was $130,556. The profit over the year is $32,694, which is the 25.04% growth. Currently, the portfolio is 97.58% invested. Cash on hand is $3,350. Our goal with this equities-only portfolio is to be as close to 100% invested as possible at all times, as long as my mechanical rules-based buy-sell algorithm is giving me buy signals to enter trades. There are 10 open positions at the moment. I have a little bit of cash on hand because I transitioned this portfolio over the last 10 months from 13 open positions down to a maximum of 10 simultaneously open positions. Over the last 10 months, I've had a full 10 open positions in the market, but had as much as 16% cash on hand because of the transition, causing lower returns than should have been achieved over this period, even at 25.04% return for the year. Let's dive deeper into some further metrics for this 1 year period. The annualized return, as I've already mentioned, was 25.04% compared to the S&P 500 total return index annualized return of 15.94%. The net profit, which I showed you on the previous value screenshot, is $32,694. Moving down this screenshot, exposure was 80.96% over the period. This is lower than expected because while we transitioned from 13 to 10 positions, longer held positions had smaller position sizes than the more recently opened positions, which stifled growth. The win rate over this period was 52.38%. The payoff ratio was 2.87, which means that the average winner was 2.8 times bigger than the average loser. These two metrics result in an expectancy of 1.03, which is a nice juicy expectancy. An expectancy greater than 0.4 after costs is an edge that can outperform total return indices over the long term. The maximum drawdown over the year was 11.48% compared to the S&P 500 total return index with a maximum drawdown of 12.85%. Slight outperformance by my portfolio. You can see the dates when they occurred. My portfolio's current drawdown percent is slightly lower than that of the index. The last two numbers to report are the portfolio and index risk to reward ratios. 0.46 means that to get the return of 25.04% for the year, I had to take the risk of 11.48% maximum drawdown. Divide 11.48% by 25.04% and you get 0.46. For the index, divide 12.85% by 15.94% to get 0.81. The lower, the better. The difference between the two provides a relative risk to reward performance metric. Over this 12-month period, my portfolio's max drawdown to return was 76% better than if I had invested in the index, which is basically buying and holding the SPY ETF plus reinvesting dividends. That's just looking at the last year. I'll analyze longer periods in detail in future videos. This is the type of portfolio analysis every investor should do, especially a mechanical, rules-based investor. I'll now analyze the positions traded for the year. The 42 positions over the last year includes the 10 currently open, so I actually completed 32 closed trades, which is a wee high for this medium to long-term system, indicating that there was a little bit of volatility which occurred at the beginning of the 12-month period in September and October of 2022. Of the 42 positions, 22 are winners and 20 losers, which is the 52% win rate, including 10 open trades, some of which could turn into losers before they are closed. The average hold period for all trades is 82 days or 11.7 weeks. For profit trades, 18.7 weeks or 131 days. And just the 4 weeks, 28 days for loss trades, which proves that using this exclusive rules-based buy-sell algorithm for medium to long-term trend-following positional trading, I cut my losers short and let my profit trades run. Next, let's look at net profit in dollars, which is $32,709. The total for profit trades only is $46,969, and for loss trades, $14,260, resulting in a profit factor of total profits being 3.29 times bigger than total losses. Next, let's look at a chart comparing the equity curves starting at the same base date on August 31 last year, between my portfolio, the blue line, compared to the S&P 500 Total Return Index, the red line. The outperformance is plain to the eye. Over time, you want the gap to get wider between the blue line and the red line, although each will take turns of short-term outperformance. Coming back to comparing annualized returns, the S&P 500 Total Return Index has slightly outperformed my portfolio over the last 4 years by 0.3% annualized, which I can live with, although I'm looking for meaningful outperformance. How did the 60/40 Vanguard Balanced Fund, VBIAX, do? Over that 4 years, its annualized return is 6.64%, which is some 6.31% worse than my portfolio. I'll remind you that the VBIAX Balanced Fund is not an equities-only fund. However, it is a relevant benchmark for the type of returns that most non-active investors get with their long-term investments for retirement. The last metric to look at are the annualized returns since the inception of this real money live traded portfolio in January 2016, 7.7 years ago. My portfolio has achieved 11.67% annualized return over this period, compared to the S&P 500 Total Return Index growing by 12.92% annualized. That is 1.25% outperformance of the index over my portfolio over the 7.7 years. In late 2022, early 2023, I did some tweaking of my mechanical buy-sell algorithm, which my customers got the benefit of too. After these tweaks, based on the historical portfolio simulation research that my business did, I look forward to my portfolio catching up to and overtaking the S&P 500 Total Return Index over the coming months and years. Now, what did the Vanguard Balanced Fund achieve over this 7.7 years? A 7.78% annualized return, which is 3.89% worse than my rules-based US portfolio that we are chronicling in this playlist. Now, what difference does 3.89% annualized return make? Over 8 years, for every $100,000 invested, that 3.89% annualized return difference pockets you an extra $59,700. And over 15 years, for every $100,000 invested, that 3.89% annualized return difference pockets you an extra $216,000. So with $500,000 invested, the difference would be over $1 million over 15 years, just for what seems a paltry amount of performing 3.89% annualized return better. Now remember, past performance is not a reliable indicator of future performance. Please subscribe and click the bell to get notifications of newly published videos. Until next time, I wish you consistent and objective investing.